Hey guys, it's Erica Hill West here with Lending Path Mortgage, your mortgage go-to gal. I've been licensed in the mortgage industry for over a decade. I also host a local radio show to talk about all things mortgages, and I manage a team of 5 loan officers. Today, we're going to talk about how to calculate your debt to income. Debt to income is a term that you probably have heard if you're in the market for a mortgage. You may also not know what it is. Debt to income, simply put, is your debt versus your income. But it's a little bit more complicated than that. Today, I'm going to break down what debt to income is and how you can calculate it for yourself before starting the mortgage process. So stay tuned. Hey guys, today we're going to talk about debt to income and how to calculate debt to income. It sounds pretty simple because it says debt to income. However, it's not quite that clear cut. So let's start first and talk about what debt to income is and how it impacts you when looking for a mortgage. In order to do that, we have to break down what we mean by income and what we mean by debt. So financial institutions and lenders, when they are looking at debt, your debt associated with qualifying, they're only really talking about the liabilities that you have on your credit report. And in addition to that, they don't mean your total debt. They mean the minimum monthly required payments on each one of those debts. The only exception to this is if you have child support, alimony, or tax debt. That's it. Besides that, all we look at is what is on your credit report for your debt. Now, I know that it's not debt, but I have a ton of other expenses that I have to pay on a regular basis just to live life. Utilities, gas, groceries, internet, childcare. The list is endless. But mortgage companies don't really look at those things. They're only looking at the debt that's reported on your credit report to calculate your debt to income. So now that we understand what we mean when we say debt, let's talk about what we mean when we say income. Your income is your gross amount. If you don't know what that means, don't worry about it. It means your income, your monthly income, before you have anything taken out. So before you have health care or 401k, any kind of benefits, and most importantly, taxes. Before any of those things come out, that is the figure that we are using to qualify you on. This may sound really strange, but it's the truth. We're looking at only the debt that's held against you on your credit report, and income, we're using income that doesn't really even come into your household. But that's what we do. And for that reason, some of the debt to income requirements can seem a little bit stringent. So next, let's talk about how to actually manually calculate your debt to income. Where we are concerned as lenders, there are 2 different types of debt to income. You have a front end ratio, which is typically called your housing expense, and a back end ratio. Your back end ratio includes all of the debt on your credit report and child support, alimony, tax debt if you have it, plus your new housing expense. That's considered your back end ratio. When we talk about debt to income requirements, we're usually 98% of the time, we're talking about that back end ratio, your total debt to income ratio. So what you do is you take your gross monthly income, you divide it by all of your debt on your credit report, not the total amount you owe, the minimum required monthly payment, plus your estimated new mortgage payment, and voila, we have your debt to income. Now, I'm going to run down what the program guidelines are for max debt to income for qualification. But remember, just because you may be under these debt to income requirements doesn't guarantee that you will qualify for a mortgage. It's just one factor in qualifying for a mortgage, albeit an important factor. So let's start out with conventional financing. Conventional financing by far is going to be the most common that you hear of. Conventional financing requires a debt to income between 45 and 49.9%. Determining how high you can go with conventional really is based on your credit score and how much money you're putting down. So just a good rule of thumb while you're trying to calculate it for yourself, I'd stay around 45. I wouldn't try to push it because you may find out that you don't get as much as you want. On FHA, max debt to income is 57%. It's a lot, right? 57% of your gross income every month. That's how much debt you can have, including your new mortgage payment, to qualify for an FHA loan based on that standard. VA is just a unicorn, if you want to know the truth. VA financing is a unicorn. They do not follow any debt to income requirements. You will hear people say, yes, they do. Yes, no, they don't. The only thing that the VA cares about is something called residual income. As long as you meet residual income, which is a fancy way of saying your net income plus a little extra. They are not looking really at your debt to income. They're making sure that there's enough money left over every month after all your deductions to make your payment and maintain your home. That's it. The fourth most common loan that you'll probably come up against is USDA. USDA, you want to keep that back end ratio to 41 or below. Now, if you are curious about what your debt to income is, how to qualify it, how to calculate it, and if you want just in general more information about how to lower your debt to income, how to improve your status before applying for a mortgage, please reach out to us. Our information is in the comments below. As always, we would appreciate you to like, subscribe, and if you have any questions, please leave it below. And if you're in the mortgage industry, you have a desire to get into the mortgage industry, we really would covet an opportunity to spend some time with you and let you know what we are all about.